this one's going to be the huge one for altcoins because it creates the concept of a mature blockchain. You have to understand there is a criteria. No single entity can control 20% of token supply, okay, or voting power. No unilateral authority over protocol upgrades. Value has come more from the blockchain functionality and not from the issuer's efforts. Now, if the chain meets that criteria, you get your CFTC oversight instead, from the SEC, right? That's the promised land for crypto projects. Now, Bitcoin and Ethereum qualify today. Most other chains, well, they don't. And that's what we're seeing as we get more ETFs. That's what we need to monitor. And that is going to give us a clarity into how we can make money in the space moving forward. Okay. So stablecoins pegged to the dollar. This is 98% of the market, by the way. USDC, USDT, of course, and others. Fiat-backed stablecoins are backed by actual currency reserves. And here's an important thing that most people miss. USD stablecoins refer to what is pegged to fiat, refers to what is actually has a backing. So pegged to is different from backed by fiat, all right? So USD is backed by or pegged to the dollar. And of course, fiat backed is backed by the dollar itself in reserve. Now, you also have algorithmic stablecoins as commodity backed like Tether Gold. And this is an emerging category that you need to be aware of. So why does it matter? The Genius Act, of course, specifically regulates stablecoins. The fiat-backed ones used for transactions. DeFi stablecoins like DAI operate in different regulatory space. So overall, in my opinion, what we need to do is the Clarity Act. So if we move over to the Clarity Act, regulation is going to be here early next year. Okay. And it's going to be, they are going to enforce it. Okay. Enforcement era is ending. If the Clarity Act passes the Senate, we know exactly who regulates everything. Staking is explicitly protected. The Act says proof of stake validation is not a security, and that's going to be huge for proof of stake chains. DeFi development gets a safe harbor, building protocols, validating transactions, developing wallets, all protected activities under the Act. This in the whole package. Proof of work chains are architecturally closer to meeting this criteria. Fair launch, no foundation, of course, no treasury, and this, of course, they are distributed mining. This is why I think Kaspa needs to be studied, right? You see Zcash, Kaspa, Litecoin, all of these. Kaspa is going to be very interesting because all of a sudden it offers an assessment of what is potentially a fair launch and very accurate distribution. This is the one coin I'm keeping my eyes on in a proof of work space because I do consider the market cap to be very, very small should something like this be triggered within this space. And that's going to be huge, guys. DeFi governance tokens get explicit protection under the Clarity Act. And of course, that's an opportunity itself. There is also a threat here. There's going to be a two-tier market. Regulated digital commodities that institutions can buy and everything else stuck in a retail-only territory with structural valuation discounts. Institutional volatility compression as more long-term holders enter those 50% daily moves become very rare. They get rich quick narrative slightly weakens in the future. Okay, so that could be in the long term, and that's 12 months plus I'm looking at over there. This is a new stablecoin treasury interconnection that creates a systematic risk channel that didn't exist before. So that is another thing we need to be worried about. So think about the institutional capital flow. I'm not talking about retail capital flow here with 4 tiers. So number one, regulated stablecoins like USDC, compliant USDT, bank issued stablecoins. This is where institutions will enter crypto. Number 2, mature digital commodities. Bitcoin, Ethereum are already today blue chips. And then you have number 3, maturing digital commodities and chains that are actively filing for certification, working towards decentralized thresholds. Number 4, everything else, retail accessible but institutionally excluded, structural discount and mayhem, and of course casino. Most institutional capital is stuck within tier 1 and 2, so Bitcoin, Ethereum, and of course anything that is heavily regulated. The flow to tier 3 depends on the regulatory clarity, and the alpha in the thesis is identify those projects from tier 4 to tier 3 that will potentially move up to become a blue chip assets. The smaller layer ones, your SEIs, your Kaspas, your SUIs. This is going to become even more, in my opinion, and of course ecosystems. We'll still be able to make good money there. Look at token distribution trajectories and consider the ownership below 20%. That's going to be key as you look through the documents, as always. And I'm not talking about, micro caps here. I'm talking about looking for a decent layer 1, 500 million or above to be able to invest in the long term. So DeFi development gets a safe harbor, building protocols, validating transactions, developing wallets, all protected activities under the Act. There's also a new $75 million annual fundraising exemption, and that is compliant tokens launches are new. It's going to be insane in the US. So these launches will be possible in the US, and that's going to be massive. Now, the weakness is, of course, stablecoins in terms of their institutional, as the institutional capital enters, the money is not maybe perhaps flowing into as many degen projects. But there is an argument. That's always been a retail market. Okay. Yield competition will be absolutely real. So this is also another negative. Why take an altcoin volatility from an institutional standpoint when your yield is 5 to 12%? That sets higher hurdle rates for speculative positions. The 20% ownership of the threshold is going to be brutal, which means most VC-backed projects and teams have plus investors holding more than 20%. They can't qualify as a mature blockchain in the near term.